Welcome to Barchart's series of educational webinars designed to enlighten you on a variety of trading ideas, demonstrate features and tools related to these concepts, and offer some traders insight to help you make a more informed decision. Today's session, chart patterns that actually work, proven setups traders use to win. Now, do patterns exist? Well, many academics and investors say that they do not. They say that patterns are only false interpretations that help the human eye put or bring order to the randomness of market data. Now, however, many market technicians, including myself, believe that patterns are a reflection of market behavior. They are the visual representations of the psychology of the battle between buyers and sellers, speculators and institutions, and in today's modern markets, algorithms and quants. Now, patterns are never exactly the same, but they can be classified by common attributes. And these attributes are related to trends and probabilities. If this, then that. And they appear throughout all time frames and are categorized into two types, continuation and reversal. Now, chart patterns are just one of many technical tools we can employ to stack probability on our side. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist. And I believe chart patterns go beyond superstition and coincidental observation. Chart patterns are a series of probable events that allows traders to assess risk and determine reward. And when used with confirmational tools like volumes and momentum indicators, dramatically improve win rates and profitable outcomes. Now, the work of scholars like John Murphy's Fundamental Principles to Classical Patterns and Thomas Bulkowski's Statistical Research to identify top performing patterns led to patterns traders can rely on for a trading edge. So stick around as I merge psychology with statistics, probability with risk management, and confirmations with technical tools to increase success rates and average gains. Now, before we get to all that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Hi there, John. How are you?
I am doing well. Hot, hot, hot. Dog days of summer, right?
That's right. It's very hot here in Chicago today. Yeah, so I just want to remind everybody in the audience that if you do have questions, John's got a packed webinar for you today. If you do have questions, send them through on your chat, and I will see what I can do to get them to John and either answer your questions myself or have John answer at the very end.
Yeah, we'll try to get through the questions. And then again, if we don't get through all the questions, you can always send your questions to support@barchart.com. And we have a great staff that can help you with that. And if they can't answer it, they'll pass them along to me as well. So ready to get started, Jean?
Yes, let's get going.
Okay. So remember that today's session is for educational purposes only. Decisions to buy, sell, and hold are based on, should be made by a qualified financial professional, and under no circumstances shall we be liable for any loss or damages you or anyone incurs as a result of any trading or investment activity that you or anyone engages based on any information or material you receive through barchart.com and our services. Okay, so there's no argument, at least I'm not going to give you an argument of if we look at a chart at any given moment in time, that price movement is random. And yet price moves from the influence of a collection of inputs like fundamentals and market sentiment. Now, John Murphy called chartists cheaters because charts are just a shortcut form of these inputs. And all they need to do is simply look at the direction to determine the imbalance of buyers and sellers. And a chart that rises from left to right is said to be in an uptrend. And an uptrend is a series of battles between buyers and sellers, with ultimately the buyers overwhelming the sellers. Murphy recognized that markets move through a series of peaks and troughs, support and resistance. And that movement between and through creates common patterns. Thomas Bulkowski took Murphy's patterns and quantified them through the levels of support and resistance to try to legitimize these patterns and quantify their predictive powers. So, for instance, like this double bottom. Whoops, there we go. So for today's session, I've chosen from my studying, practice, and experience, and backed by Bulkowski's research, 5 patterns that are both easy to recognize and most effective. And those 5 are the cup and handle, measure move up, ascending triangle, double bottom, and inverse head and shoulders. And based on 4 qualifiers: success rate, did the pattern reach a measured target, and not just directionally correctness, in other words, instant gratification, but a projection of potential. Failure rate, they had no breakout or an immediate reversal. Breakout performance, an average of gain post breakout. And throwback likelihood. Now, there's a little semantics here that the word throwback or pullback, you've probably heard that. But in the world of technical analysis, a throwback is where price retreats from a peak, but they can be interchanged. But throwbacks will help us to manage re-entries and risk. Now, I've chosen all bullish patterns. Now, there are bearish patterns and there are other bullish patterns. And again, my choice is based on recognition and occurrence experience. Now, there are others that have higher probabilities, but their occurrence is rare. So let's just jump right into it. And the first one we're going to talk about is the cup and handle. So the cup and handle is a bullish continuation pattern reflective of accumulation and shakeout. Now, there is a mistake here. Sometimes traders will refer to cup and handles as a bottoming reversal pattern found after, let's say, a downtrend. And then that could happen. But Bulkowski noted that he found an effectiveness of early continuations, and these patterns tend to be very reliable. The psychology is buyers step in steadily, that's the cup formation, and then weaker hands exit on the handle pullback, again, drawback, before the breakout. Now, there are some characteristics that we can talk about before we get to the entry point. So you might see a cup that occurs over somewhere between 7 to as much as maybe 65 weeks. And the decline from the peak should be somewhere around 15%, but could be as much, but not more than 35%. Symmetry adds to the reliability, and the cup itself, the duration should be around 1 to 4 weeks, and it should be slightly downsloping or at least sideways. Now, when we talk about entry points, we're going to buy on the breakout above the handle resistance with a volume confirmation. Now, when I get to the pro tips, we can talk about adding other confirmations. One that I would do right off the bat is I would wait for a breakout close above our level of resistance. So our target would be the depth of the cup added to the breakout level. And on a risk management, we're going to place our stops below the handle low or use some form of an ATR-based stop. Now, again, the pro tip here is expect throwbacks, a 58% likelihood, and don't chase above the breakout without a very specific plan. And then the stats here is about 68% success historically and an average gain of around 34%. So let's go and look at an example. And let me start with this one. And this is Phillips 76. And let me go down to 3 months. So let's take this template off here for a second here. I'm gonna make this a little bit cleaner. Okay. So there you can see, right, if price rally is up, buyers find resistance, the market pulls back, buyers support the market, and then again, the price creeps up, buyers get a little bit anxious, maybe give up, and then you get that little bit of a throwback, but then buyers step back, support the market, and eventually you get a breakout. Now notice that I was talking about confirmations. And so any point here, if we got a close above our lip here or our line of resistance, that would be a buy signal. But we can add other technical tools to help us in confirmation. Now, sometimes that might delay an entry, and that delay in entry might also increase our dollar risk, but might increase our probability of success. So one of the ones that we can look at, or two that we can look at, are MACDs and RSIs. So let's start with RSI. So, you know, if you've been in a lot of my webinars, when I talk about RSIs, not only is this a way to look at momentum or the old school overbought, oversold conditions, but you can also use RSIs as a way to confirm trend. And so in uptrends, typically, you will see that an RSI will not fall or will hold the level of around 50%. Sometimes it'll penetrate, but it should not go below 40%. And so you can see here that our cup and handle, both of those retreats, we held above 50% as an indication that we are in an uptrend. And then on the breakout, we can see a rising RSI that had yet to reach the overbought conditions. When we look at the MACD, again, this is a momentum indicator, and the standard common interpretation is when the MACD line crosses the signal line, this is a buy signal. But again, like the RSI, in a uptrend, the MACD lines will be above what is called the zero line. In other words, in positive territory. So when we get a breakout or we see a breakout, we want to also see that our MACD is giving us that buy signal. Now, another thing that we're going to talk about a lot today, and I'm going to mention it, is volume. And volume is important for us because it is kind of the validation to our price. Again, let's look at this from a volume standpoint. Now, let me take a second here. I just want to turn off these moving averages so we got a little bit of a cleaner sheet here. And what we see here is, this is kind of typical, is when we get to that lip for that shakeout, you will see a bit of a spike in volume. That's part of that shakeout process. But during the candle portion, what normally you will see is lighter than normal or lighter than average volume, which is what we're seeing here. And then on the way out, what we want to see is a surge or this increase in volume. Now, there is an anomaly to this particular example, and this is why I chose it, is that this one bar here, this one volume bar, might be distorting our average volume level, which is represented here by the black line. And what we can see here is there's a large amount of volume on this little teeny candle, this candle of indecision. So this was a decisive battle between buyers and sellers. And, at the point at this day, we don't know which is going to be the winner. But think of it like the Gettysburg battle, right? The battle was a tie, but what happened from it? That was the turning point in the Civil War. So we can see here what happened from this battle. Well, the turning point shows that buyers got back in control. So if I look at this from a volume standpoint, I think this is more reflective of a very strong bottom, and that if we look at the volume on the breakout, it's probably just a weak confirmation. Ideally, we probably want to see our volume stronger throughout the following days and not drop off like it had here. Let's go back to Apple for a second. And what we see here is, again, a bit of a cup and handle, but what do we see here? We haven't yet broken through the line of resistance. But this is also something else that I want you guys to start being aware of, and this is an idea that's called fractal recognition. So in other words, patterns inside of patterns, or patterns that repeat. So notice that there's a purple arrow here. Now watch this. I'm going to go down to a 30-minute time frame, and let's shrink this chart up a little bit. There's that purple arrow. That the handle in the daily looks to be a cup in the 30-minute time frame, and that here is a small handle. This is called fractal recognition, a pattern inside a pattern. This is usually a very good sign of that our pattern is going to play out. But again, what we need to wait for is our breakout, and the daily has yet to break out, and certainly the 30-minute time frame has yet to break out. Okay. So the next one is measure and move up. Now, I think this one is more applicable for us because it fits into our buy the dip mentality. Some of you might not be familiar with this chart pattern, but this is really more about characteristics of uptrends. And so the idea is that bullish continuations are in three types of phrases: this advance, consolidation, and a second and advance. So the psychology behind this is really this strong initial move, right? A lot of buying, then a healthy amount of profit taking, and then a renewing of buying that reinforces our trend. Think about, or why I wanted to feature this is that what are trends? And trends are just a series of impulses and corrections. Impulses and corrections. So an entry point here, we're going to enter on a break from consolidation, and those consolidations could take the forms of flags, pennants, rectangles, but here we definitely want to look at some of our momentum indicators to help us to confirm the breakout. Target-wise, we'll measure the leg in and the impulse out. Risk management here is we're going to put a stop below our consolidation low, and as the market moves forward, we can use a trailing stop on that second leg. The pro tip here is this really works in trending markets. In other words, in an uptrend is a series of what? Higher highs and higher lows. And that volume can validate our price. But other things like moving averages can also add support to our levels of consolidation. So here's Palantir, certainly a stock that we all know, and we know that it's been in a crazy uptrend. But there we go. There is our impulse, our correction, and then we measure our impulse to give us a projection. Impulse, correction, impulse. Notice that our flag here, our flag of consolidation, is supported by our 50-day moving average and our 20-day moving average. Now let's go back and look at Palantir at the origins of this major uptrend. Impulse, correction, impulse, correction, impulse, correction. So again, pro tips, many times your impulse and corrections in trends can accelerate. That is another confirmation. But notice these circles here. These circles represent gaps. And gaps, definitely when they're associated with our impulse moves, give us greater confidence in our trend recognition. So let me give you another quick example here. This is Center Point Energy in this kind of that AI space. Again, here's that impulse. You can see a little bit of a down candle here, but this impulse, correction, nice little flag, impulse, correction, impulse. So I want to talk about this triangle here. This is not one of the patterns that I'm featuring today, but I thought this would be a great time to give you a little bonus coverage here, is that in these correction periods, if we can start seeing another type of fractal, in other words, patterns inside of a pattern that support our thesis, in this case, our uptrend. And so what do we see here? We see, two lows or a double bottom and then an ascending wedge. Now, if you look this up in a chart book and said, like, what is the characteristics of a rectangle? This would be like a textbook example. The market ranges between a highs and low, relative highs and same lows. But at some point, there's something called a shortfall where the price will not fall below the 50% mark of that range, or if it was a breakout to the downside, it wouldn't go above 50% to the upside. And that this shortfall support is linked to or related to this ascending triangle. So what we're seeing here is two bullish patterns inside of a consolidation of an uptrend, another type of fractal recognition. So since we're talking about ascending triangles, let's talk about what it is. And so the key idea behind ascending triangles is that they are bullish continuations with rising demand pressing against a horizontal resistance. The psychology, right, higher lows signaling a growing buying pressure that eventually overwhelms the sellers at resistance. Now, characteristics. You might have dwindling volume in the ascending triangle, or a lot of times you will see volume bursts from the ascending trend line. Now, we do get a diminishing effectiveness in large cap or highly traded stocks versus some of our lower volume or, let's say, less active mid to small cap stocks. Now, there is a bit of a risk to this, although this one is one of the more probable. So we want to make sure that in terms of risk management, we want to have a very tight stop, and that we might hold this to a higher threshold on confirmations. So things that we can look for are gaps and multiple closes above resistance, especially in those highly traded markets. You might get a lot of false breakouts. But the breakout itself, according to Murphy, should materialize somewhere between half to 2/3 from the base to the apex. But I give these ones the benefit of doubt, and I don't want to see it go past more than 3/4 of that triangle. So here's a really beautiful example. This is like a textbook example, right? Rising wedge, right? Triangle, level of resistance, a breakout here on a gap. There's a gap right there, and volume confirmation. Here's Google. Some of you might be familiar with this stock, right? Well-defined uptrend, nice channel, rising trend line, level of resistance. Here's our ascending triangle, and you can see that we have now broken out of it. But again, this is a widely traded stock. So did we get a strong confirmation? Maybe some of those other things that we talked about, volumes and our MACDs, we maybe not. You'd have to go and look at it, but it might have been multiple days before we got to what I would consider a good confirming breakout. But you can see this one certainly feels like it is still continuing in our direction, and you can see where that target could be. So again, pro tip, wait for a daily close above resistance, and maybe multiple days, I think, on this one, especially on those highly traded ones, to avoid those false breakouts. And again, this one has a very high probability win rate once it does break out. But again, there tends to be a lot of these minor false breakouts, especially in the widely traded stocks. All right, so that brings us to double bottoms. And the key here is this is a bullish reversal signal where sellers are exhaustion and buyers take control. Now, bullish reversals can be bottoms after a prolonged downtrend or an extension of consolidation. In other words, a long period of consolidation could create a double bottom. The psychology here is that the troughs, that you have these two sharp tests of support that scares out weak hands. And then eventually buyers do step in on the failure to make new lows. And that could be the beginning of a short cover rally, or it could be because buyers have determined that is a value that they want to own. Now, the characteristics of a double bottom, the troughs should be within about 5% of each other in terms of price. And ideally, the second trough should be higher than the first. From a peak to trough, probably want to see something greater than 10% from our first trough. And chart duration, well, somewhere between 2 to 6 weeks. Longer lessens the reliability. But here's one stat that you need to know is that the average follow through usually is only about 70% of the measured move. Our entry point, we're going to buy in a breakout above the peak between the two lows. Again, that will be our confirmation line. And our target, again, will be the pattern height added to the breakout level. Risk management, we're going to set our stop below the second low. And the pro tip here, volume confirmation on the breakout improves our reliability. But watch for these undercut swing lows just before a the breakout. In other words, potentially a bear trap. What I'm saying here is that sometimes just prior to the breakout of a double bottom, you could get a formation that looks eerily similar to a cup and handle. In other words, this swing cut low could be a handle-like formation before you get the breakout. Now, in terms of stats, nice 65% success rate and a 40% average gain. So let's go to, remember in the opening segment, we looked at Microsoft and I showed you that double bottom, okay? And what do we see here? Again, what is Murphy telling us? That patterns are really this ideal reflection of the psychology of markets between levels of support and resistance. So, excuse me, support and resistance. And what we see here, we see a nice double bottom where the second bottom is slightly above the first bottom. There's our peak between our two bottoms. That's going to be our confirmation line. And in this example with Microsoft is we did get a breakout, but notice that probably a quick failure. And so this is one of the stats that you need to understand from double bottoms. This one has the highest throwback value. I think it's about 70%. So expect that impulse retracement, that impulse correction. Now, this one looks like a failed follow through, but notice, again, we're talking about fractal recognition. The drawback on this one, where we failed, creates another double bottom. And then the breakout, the second breakout, is the one that gives us our bigger picture projection. Now, these two purple lines, if you want to go back and dissect this, these two purple lines represent measured moves. In other words, I'll measure moves from this low to this peak high. So that's what we're seeing here is that on this second leg, this breakout move is a bunch of measured moves. Really, the true breakout is our red line. But again, here we're seeing a pattern inside of a pattern. In other words, that fractal recognition. Here's EQT, again, in the energy space. There is our two bottoms. There's our measured move based on our peak between our two lows. And again, if we look at this in big picture, this is not a bottoming, but a long period or extended consolidation. And then there's our projected move up to around 66, above $66. But again, in these types of double bottoms, a couple things that are characteristics. First of all, it struggles to get above that first layer of resistance. There's a high throwback probability. And in terms of our projection or our measured move, we're only going to get about 70%. And so this one really worked out well in terms of that predictive power. All right, let me show you one more before we move on. Why I have it right teed up here. Okay, this one is Raytheon. And again, here's our double bottom here. And notice that our second bottom revolves around a corporate event, in this case, earnings. So that is really a kind of a nice confirmation in terms of finding a bottom. In other words, a corporate event creates volatility, and then whatever happens past the event is probably what is going to set the trend in motion. But also in this one here is, again, notice here's our peak. There again, this indecision as we get to the top of our resistance. And what did I say? That you could see that cut back, right? Look at that. I mean, this is not a cup and handle, but that certainly looks like a handle-ish type formation. Now, what we might do is we could go down to, let's say, a 30-minute time frame or lower, and this might actually be a cup, and there might be a little handle in here. But here's our throwback, and then eventually we get to our projected target. Now, here's another thing, especially on these formations that are found in dailies and weeklies, these patterns, is that the cycle or the projection of the pattern might be related or a cycle of corporate events. In other words, you can see here the last earnings started the rally, and now we have, the market peaked, certainly in the short term, peaked before it sold off based on this earnings event, which happened yesterday. But now we're seeing the market is going back up. And again, this might be start of a new secondary uptrend. All right, inverse head and shoulders. Again, a major bullish reversal signal that shifts from a downtrend to an uptrend. Psychology here is that selling pressure weakens across successive lows, the shoulder to the head, and buyers gain strength from the head to the shoulder. Now, this is one of the most commonly quoted and famously recognized chart patterns, head and shoulders, yet it does have a very high probability of success compared to a lot of other patterns. The top reversal pattern, the one that the head and shoulders that most of us know of, is one of the most overanalyzed patterns. But let's talk about the bottoming pattern, or the inverted or inverse pattern. So on the bottoming, the right shoulder, the second shoulder, that is lower than the left shoulder, really does add to the performance. Think about this is really about trapping more of the shorts. Now, symmetry does improve recognition, but not necessarily the performance. Our peak resistance can be horizontal, but in these inverse bottoming head and shoulders, they're more likely to be a slightly downsloping trend line or neckline. Now, the entry here is very, very important that we do a volume analysis. It's more important than we have seen in the other patterns. Those ones are more confirmational. This one is really very, very important. So the pro tip here, well, again, the target again, add that vertical distance from the head to the neckline to measure that potential breakout. So the pro tip here, again, management are going to use our right shoulder for our stop, is that watch for pullbacks. Again, another formation that has a lot of pullbacks. Commonly, at least one out of every two is going to give you a pullback opportunity. In other words, that drawback to the level of the breakout. And so there's no real reason why we need to chase this one. And remember, think about our trend. Remember, this is the bottom of a new old trend, downtrend, in the beginning of a new uptrend. So this is really that start, or that first or second impulse and correction impulse second chance entry. So let's go back to our example on Phillips 76. And remember this, we were looking at this from the ideal of a cup and handle. But let me change, our data set here. And what we see here is, right, a downtrending market, right, where we have a left shoulder, a little bit of a rally resistance ahead, and then a right shoulder. Now, if we look at these two together, you can see that that selling pressure has been across this consecutive lows and highs. Our low shoulders are relatively the same, maybe a little bit slightly higher on the right. There's not some symmetry in this one, is there? Our red line is our line of best fit. That was really more related to our cup and handle. And what we can see here, that the blue line is really this down sloping neckline. And so this would be the line for us to break out of. Again, when we talked about patterns inside of the patterns and this inverse head and shoulders, that you could see that kind of that false breakout, undercut, and then finally get that breakout. Also, we talk about that these have a high percentage of that drawback to the breakout line or neckline. So remember, we said that volume is important for this one. And what we said when we looked at this from an analysis of a cup and handle, that volume was a weak supportive indicator. And you can see that here, right? So there's probably, this one might be a failure. But here's the thing. Friday, Phillips is going to have an earnings report. And that might be the catalyst from a volume standpoint and a conformational standpoint for this chart pattern to play out. So I would say this is certainly one that I would be watching in the future. And again, I could probably use a very tight stop, this most recent swing low. And what I really just want to see is a rise in price on some strong volume. All right, let's change this to weekly. This is Coinbase. Again, more of a classic bottoming formation, right? We could think about, again, that horizontal line of resistance. We can see that here. But again, a lot of these inverted head and shoulders have this downsloping trend line. And so that downsloping trend line can be your line of your breakout. Now, which is really interesting about this one, it really fulfills all those characteristics that we just talked about. Here's your breakout, that explosive movement, but it ran right into a level of resistance. Then we have our throwback, right? Or potentially maybe what might be a failure. Again, probably a little bit of what looks like, again, a handle of maybe a much larger cup and handle. Not a traditional round bottom cup, but there's that handle or that cut back from a level of resistance. And then eventually the horizontal line or that neckline is our conformational breakout that eventually does get us to our target. Now let's go down to daily, and we're going to move forward in time. We're going to look at recent price action. Again, this is more of a classic head and shoulders, right? With our neckline being more of a horizontal neckline here. right? Left shoulder, head, right shoulder, a little bit more symmetry in this one. Right shoulder a little bit higher than the left. Again, if it was lower, that would give us a lot more performance. And then again, a much better confirmation, right? A breakout on a gap. Here's our measured move, right? Measure move consolidation, measured move. So again, more of a traditional inverted head and shoulders with a very strong breakout. Now, I'm just curious on this one. I hadn't looked at this beforehand, but I do have a little bit of time here. Let's see what this looks like with volume. Oh, and there you go. Nice volume indication on the beginning of this breakout right there. Okay. So good volume there, and then another secondary wave of volume. So that is a really good sign on this particular one. And then again, on our measured move, look at how we see volume again peaks up. All right, so let's do this one. I'm going to show you a little bonus on this one because I didn't talk about this chart pattern. This is a more rare chart pattern, but it's one that I want you guys to kind of watch for. And this is called a high and tight flag. Now, normally what you'll see in this one is you get a large impulse move, and then it's followed by 2 to 5 bars or 2 to 5 candles, or in this case, 2 to 5 days of small body, small range candles. And then you get another nice breakout. Again, could be a little bit of a gap. That could be that confirmational piece. Again, volume is a good piece of information on this one. This is called a high and tight flag. And they're very rare, but again, really good probability trades. All right. All right, so let's review some of our risk management techniques. And I know I went through a lot. Don't forget that all of our videos will end up in our archive or our YouTube page. You can watch the videos, slow this down a little bit. But let's talk about cup and handles, right? Expect those throwbacks, right? Use volume as a confirmation on the breakouts. And we're going to place our stop at our handle low. Our measured moves ups, right? Again, think about measured moves ups. This is really an uptrend, right? Impulse correction, right? Strong trending pattern. Breakout legs may accelerate. Remember the Palantir example. Gaps offer a greater confidence. And this is a really great way to use our trailing stops. Ascending triangles enter on a breakout close. Again, remember, we want to say the word close. We just don't want the price to get above, especially on those larger traded stocks. Place our stop below the ascending trend line and watch for those failed breakouts. Be careful, we want that, especially again on those high volume candidates. Double bottom, confirm a breakout above the peak between the two bottoms. Don't jump in too quickly. Remember, you get those cut back little handle retracements. Again, I would probably hold this one at a higher level. I'm going to see multiple days above that breakout peak. And again, I don't worry about missing on this trade because of the potential of some of these throwbacks. Inverse head and shoulders, place a stop below the right shoulder. The neckline retest is common. Again, another one where I'm going to wait for market to come back. The impulse correction, remember these are the beginnings of an uptrend. So, that's when an uptrend is really struggling. So you'll get that impulse and that correction, and that really those second chances are better chances. Okay, so I see some questions are starting to pile up. Let me get through one more slide and then we'll get to some of your questions. So there are some additional patterns that we didn't talk about today. I'm just going to leave this slide. It's in the slide deck. I'll show you how to find that in a moment. Again, some of these are really more about these consolidation pieces or more classical type of patterns, maybe that might not have as high as probability or occurrence. But inside of our archives, if you're watching on YouTube, go to our YouTube channel. We do have a webinar that is just uniquely head and shoulders, and we have one for cup and handles. So if you really want to zoom in or get the details on those, I would recommend watching those two webinars. Okay, so here's the kind of the final thoughts. Let me go through the final thoughts, and then we'll get to some of your questions. Okay, chart patterns are not crystal balls. They're structured reflections of this trader psychology, right? This battle between our buyers and sellers. And the best trades utilize this idea of confirmation tools, for instance, volume, moving averages, and momentum indicators. So let's stop there for a second. So if I go into our investing page here, and I click on investing page, under technical ideas, there is something called the MACD buy signal. So what you could do here is you could go in here and look for those stocks that are creating that new buy signal in the MACD, and then look for those where the MACD is in the positive above the zero line, and then see which one of those might be one of these patterns that we just talked about. But the other thing that I said to you that is really important, especially in a lot of these patterns, is volume. That volume validates price. So if I come to Barchart screeners, under Barchart screeners, you have something that's called strong volume gains. And again, if we pull this up, it's going to give us a list of characters. Now today it's given us 74. Yesterday it was almost 200. So again, what you could do here is a couple of processes here. First of all, you could come in here and say, all right, well, let's just kind of go through this look and this list and see if there's any stocks that I'm interested, or maybe they're in a sector or a group that I feel that has a lot of high momentum, right? I could go through the flip charts and just look at each individual chart. And I kind of did that this morning. I picked out a couple here. So the first one I wanted to look at would be, again, knowing that volume is one of our main criteria. So the first one that I saw was this OK low, which is in the nuclear space. Well, I'm going to give you guys a little test here. What pattern do you guys think this is? Yeah, a cup and handle. But have we gotten the confirmational breakout? No, we have not. But this could set us up. We could put this on watch list, say, hey, I'm going to watch this. I'm going to wait for those confirmations. But certainly we got one piece of that puzzle is that we've got a large volume today. Here's another one. Let's see. What does that look like? Yeah, a double bottom, right? Bottoming formation after a long extended downtrend. Again, right? Volume was kind of the indicator where we were, but did we get the confirmation in terms of price action? No, we're not. We're waiting to see, right? In other words, we might let this thing break out and then look for that retracement. But here's one other way we can do this, and this is really kind of cool. Go back into the filters here, and we're going to add one more filter. Think about how some of these patterns are based on a long period of time, maybe over a series of days or weeks. And so one of the old school technical analysis on the older traders, something that I learned a long time ago, is that they like to see markets make new 4-week highs. Well, 4 weeks is really 1 month. And I could add that. And let's say we're going to look for our stocks that are making a new 4-week high, new monthly high within. Now you could make it over a period of time, but let's just kind of use 2 sessions. I mean, today and yesterday. And, it knocks it down a little bit, but notice that if I go in here, I don't think those 2 examples that I showed you, well, the S dot did, but the nuclear one didn't, because why? Because we haven't gotten that price confirmation. But again, you could look in here and look for a sector or a industry group that you feel that has good momentum. So this is a real good way to use volume first as our indicator, and then go back and look for those chart patterns that we like with our volume. Okay. I apologize for being a little bit long today, folks, but I really think that that was something I wanted to show you. All right, let me see if I can get to some of these questions, Gene, so give me a moment here.
Yeah, while John reviews questions, just want to remind everybody about our membership options. He's been showing you a lot of different chart templates on his charts and saving annotations. And to do that, it requires a membership. We do have a free trial to both our Plus and Premier memberships. Will give you all sorts of options as far as saving multiple templates and applying them, saving the annotations to your charts and so on. The other thing I want to point out, again, we've got a lot of questions here, so if John does not answer them, please email support@barchart.com, and they'll be happy to see if they can get you an answer.
All right, thanks, Gene. That's some good points there. A couple questions here. One is, do patterns continue after earnings, or do they break down? Well, it depends. But usually if something happens after, again, think about this price is just a reflection of the balance between buyers and sellers. That's what Murphy tells us, right? And that what are some of the things that influence price? Well, market sentiment and fundamentals. And certainly earnings is part of that fundamental equation. So a trend that is established after earnings is probably a trend that is going to continue. So if that chart pattern is in that trend and the fundamental analysis supports it, then that pattern could continue. K-Web's asking, what is the calculation of success in a percentage? The stats are not particularly higher due to human action. Again, K-Web, this is what we're looking at here is a culmination of a lot of technical information. And the game that we play, and I don't care, we can have this discussion, but the game we play is probability. So what we learn from these chart patterns is that at 65 or 70%, that's a very strong probability. Think about it. If I'm willing to take risk on a trade, which would you rather have? One that is a coin flip, or one that it has a 60 or 70% chance of probability? Remember this difference between probability and randomness. So the probability, the greater the probability, also might allow you to take a little bit more risk, or be a little bit more patient in selecting that, that exit or that potential target area. Okay. Scott asks, how does know the gap will be filled before the next move up? Well, again, Scott, there's a lot of theories behind gaps. I will recommend that I watch a couple of my webinars. I think I've had at least 3 or 4 on gap technical analysis. But if you have a gap up with a strong volume, that's probably a sign which you're going to get what's called a gap and go, especially if that price action is outside of the previous day's range. That's called an outside gap. And so that's probably one of those gap and goes. If you have a weak gap or a gap that might be inside of the previous day's range, that's called an inside gap. then those are more likely to be filled. So again, a lot of these chart patterns that we're looking for that confirmation, an outside gap, a gap in go, is a really strong positive correlation. All right. Gene asked a great question. Do these chart patterns apply to commodities like corns and beans? Yeah, these chart patterns translate across multiple asset classes, commodities, Forex. Yeah, so definitely. Wayne asked me about double and triple bottoms. Wayne, again, this is just another type of market analysis or technical analysis. A triple top, again, the old adage, from World War I was, two on a match is lucky, three in a match is unlucky. So, a triple top is probably more likely going to fail than a double top. But I'm sure there are some good rules. Haven't really done the details on that one. Again, where we do a purchase on a dot on the bottom, we would wait for the confirmational above the peak between the two bottoms. Boy, a lot of great questions here. I think I got a lot of them. So here's a great question. Do patterns need to happen above the 200-day? Because you've heard me in other webinars say nothing good happens below the 200-day moving average. So I would answer that patterns happen all the time at all different time frames. And what we're looking for, again, probability, is if I can find a bullish chart pattern that is using, let's say, a breakout above the 200-day moving average, or that consolidation or that correction would be supported by a 200-day moving average, then that would increase the probabilities of that chart pattern, okay? All right, I think I got to a lot of your questions. Again, if you have any other more questions, go ahead and send those to support@barchart.com, as Gene has told us. Next week, we are off, and in 2 weeks, we'll have, sometime in the next few days or so, we will have a description up for which are what we're going to talk about, probably something technical analysis basis. But you can see I'm under the archive page here, chart patterns that work, and here is where you can download those slides. But I will give you guys a tease. In 3 weeks, we're going to have a special guest, and that special guest is going to be Jim Van Meerten of our chart of the day. And Jim and I are going to show you a trading technique where we're going to cherry pick and front run institutional traders. We're going to let them do the fundamental analysis work for us, and we're going to learn how to step in front of their trades to allow us to ride their momentum. And I think those of you guys that are momentum or swing traders are really going to enjoy that. So look for that one in 3 weeks. All right, Gene, great. Thanks for all your help, folks. I really appreciate you guys spending time with us. If you're watching on the YouTube channel, please give us a thumbs up, drop us a line or a comment. Until next time, the best of health, manage your risk, and the good of all trading.